Imagine you've saved up 2 million in liquid assets during your career and are dreaming of a retirement filled with travel, hobbies, and even helping your kids buy their first home. But that nagging doubt creeps in. Is it really enough? What if the market crashes, inflation soars, or life throws an unexpected curveball? I'm David Abel, an independent financial planner, passionate about helping dental practice owners turn retirement dreams into reality. And today's video, I'm going to walk you through a real-world case study using powerful cash flow modeling software. We'll start with a typical scenario for a dental practice owner in their 50s, and then tweak and optimize it step by step, factoring in lifestyle expenses, inheritance goals, and market risks. And have a look if 2 million will be enough in this scenario, and if it's not, what we can do about it. Let's jump in. So I'll briefly explain how this cash flow modeling software works, but let's talk about the couple, Johnny and Julie Flossman, and their current situation. So they're both around 55, they're in good health, and they're planning to retire age 60. They own a dental practice and they want to sell it at that stage and get some exit value for it. They've built up some savings over their career and we've input that into the cash flow. So we've got the cash holdings here, 120,000 in a savings account, 50,000 in their current account. Johnny's built up stocks and shares ISA over the course of his lifetime at 220,000, and that's invested in a balanced portfolio, which for the purposes of this exercise is a 50% equities, 50% bonds split. The same with his pension. He's built up a pension of 780,000. Julie has got a stocks and shares ISA of 110,000, and she's got a personal pension of 300,000, and they are all invested the same way. Now let's have a look at the income. They've got a salary of around 10,000 each, and they pay each other dividends of 90,000 to keep under that £100,000 threshold. They've also got their state pension, which will kick in from age 67. And Johnny's got his NHS pension here of 10,000 a year from when he retires. We can also include contributions into the plan. So Julie's going to be contributing 30,000 from her business into a pension from now until retirement, which will be 5 years. And that's the same with Johnny as well, 30,000 going into his pension. I've also listed the proceeds of the dental practice sale. Now this is really useful because we can put in different values, exit values, and it will give you an idea of if the value you're getting is enough or if you need to build the practice to sell it to be able to give you that dream lifestyle. But for the purposes of this, I'm saying there's going to be a net income of 500,000 after tax paid in 5 years. And then if we look at the expenditure, we've got current expenditure of around £120,000 a year, and that's from now until retirement, which is 2030. Then in 2030 to 2040, it's going to be 100,000. 2040 to 2055, 100,000, and that's when they reach age 85. And I've stepped back the expenditure then because they're not going to be as active, they're not going to be spending as much money. The caveat to that is if they need care, they might need more, but for the purposes of this exercise, I've not included that. Now I've broken these figures down here because it may be that they want to tweak these and let's say increase this at certain parts. So increase this to 120, maybe decrease that to 90, just to understand if they can make the most out of their active retirement. And what this model will show us is it will show us their current plan, but it will also run it through historical scenarios. So it will look back over 110 years of history, and it has data from 1915 that looks at asset classes and growth rates, inflation, and it tells us how sustainable this plan will have been through those scenarios in history. So it will take the growth rate of their investment portfolio and it will give us an idea of the growth over the long term and if that's going to be enough to be able to give us that retirement income. So it will start a plan on January 1915. It will start another plan on February 1915, March 1915, etc., until it's run a number of scenarios. In this instance, it's run 756 scenarios. And what it's telling us is in 15% of those scenarios, it's sustainable. in just under 85%, there are future adjustments needed. So this isn't a strong financial plan, which means the spending is too much based on the assets. Well, what can we do about this? Well, we can do a few things. We can either tweak the contributions that we make, so we can increase these contributions and see if that makes a difference. So let's have a look here. If we increase Julie's pension contribution to, let's say, 45,000 and Johnny's to 45, is that going to make a difference? It's going to make a slight difference, but it's not going to have a big impact. So we can have a look at that as an option. What we can also do is change the investments, because in this scenario, the client is going to be invested until their age 100, which is 45 years. It's incredibly important that the investment strategy is aligned with growth, because otherwise inflation is going to erode the value of their money. So what we'll do, for the sake of this, is look at a investment strategy which we would recommend based on these circumstances. I'm not going to go into details about the investment strategy now, but as you can see here, it's made a significant difference in the sustainability of the plan. And it shows us the best and worst case scenarios. And it's saying, well, if we were to tweak the investment strategy alone based on the current circumstances, and again, that wasn't with the increase of contributions that we've made in the existing plan, then in just under 95% of scenarios, they're going to have enough to retire based on those goals, which is really positive. Now, the big change there is the equity content of their investment portfolio, and that's what is driving those returns over the long term. Again, I'm not going to get into detail about the investment strategy here. This is just meant to show you that the investment strategy has a dramatic impact on sustainability of financial plans. But what we can also do here is say, well, we're in a really strong position. We've got 95% sustainability. We actually want to do a bit more during that first 10 years of retirement. What does that look like? If we wanted to increase our spending here to 125, and assuming at this stage, once they retire, their kids are going to left home and they would have cleared their mortgage, they'll have more free income. That's enough for an incredibly fruitful retirement period. And what does that do to the plan? And this is where we can have interactive conversations and really iron out what a good, strong financial plan looks like. And you can start mapping out what you really want to do with your time, whether that's gift more money to help your kids out, or it's spend more money on family holidays, or whatever that looks like to you. But you have more options. Again, what we can do is, if you wanted to increase, let's increase the spending figure dramatically. So let's say we're going to take this up to 160 for the sake of this plan. And that's going to bring the sustainability down to 74%. What we can then say is, well, we can afford to put in an extra 30 grand each from the business for the next 5 years. So if we tweak the contributions, the pension contributions that we're going to make during this period, what does that do to the plan? And if we go back, it increases the sustainability to around 87%. So we start getting an idea of how much money and if what you've got is going to be enough. Now, what we will have created here is, because we've got a strong financial plan, we're going to have quite a substantial inheritance tax problem. And what this can show us is, let's have a look at the median example. It can show us how much we're going to have in terms of a balance. But if we look at the IHT, what we can have a look at here is, well, I've assumed the main home's 2 million. They've also got a rental property as well. So we can have a look at the current value of their estate, but we can also look at that going forward and how we can solve that by using different inheritance tax strategies. But I think as a first port of call, we need to understand how much is enough, and is what they've worked so hard to achieve going to be able to help them out in this scenario. And that's a real difference between a financial advisor and a financial planner. A planner should be able to give you that comprehensive advice to give you peace of mind that you are on track, you're doing the right things. And if you sell your practice for a certain amount, or if you have enough in your pensions and ISAs, you're going to be able to meet your goals of helping your kids out. You're going to be able to meet your goals of having that financial independence, that financial freedom, which is really important. If you thought this was interesting, drop a comment in the comment section, or if you've got any questions, again, just drop it in the comment section. If you want to book a meeting to talk anything like this through with your circumstances, there's a link in the show notes, and there's also a link to a financial assessment, which will give you a score out of 100 to how strong your financial plan is, and it also gives you some pointers on how to improve. Hope you've enjoyed this session, and if you've got any other videos that you want to see, reach out to me and let me know.